Okay, I need you to stop everything you're doing right now. Because what I'm about to describe is so unprecedented, so constitutionally chaotic, that when I first read the analysis from Deutsche Bank, I thought it had to be wrong. It's not wrong. It's actually being discussed by serious economists at major financial institutions as a genuine possibility. Here's the scenario. Donald Trump fires Jerome Powell as chairman of the Federal Reserve. He appoints his own person, someone who will do exactly what he says, lower rates, print money, whatever Trump wants. But Powell doesn't leave. He stays on the Board of Governors, where his term runs until 2028. And then, and this is the part that breaks your brain, the Federal Open Market Committee, the body that actually sets interest rates, refuses to recognize Trump's appointee. They hold a vote. They elect Powell as their chairman, not the official Fed chair appointed by the president, their chairman, for internal purposes. Suddenly, America has two Federal Reserve chairs, one recognized by the White House, one recognized by the actual bankers who run the system. Two different people claiming authority over the most powerful central bank on earth. Which one do the markets listen to? Which one do foreign governments recognize? Which one's interest rate decision is actually binding? This is not a hypothetical from a political science textbook. This is a scenario that Deutsche Bank, one of the largest financial institutions in the world, has explicitly outlined in a client note. Stay with me until the end of this video because I'm going to walk you through exactly how this happens, why it's constitutionally possible, and the absolute market chaos that unfolds when the Federal Reserve splits in two. Let me take you back to 1948. Because history is about to repeat itself in a way nobody expected. Marriner Eccles had been chairman of the Federal Reserve for 14 years. He was a legend. He helped guide the country through the Great Depression and World War II. The Federal Reserve headquarters in Washington, the Eccles Building, is named after him. But in 1948, President Harry Truman wanted him gone. Truman disagreed with Eccles' monetary policy. He thought rates should be lower. Sound familiar? So Truman did something unprecedented. He removed Eccles as chairman and appointed someone else. But here's what Eccles did next. He didn't resign from the Board of Governors. His term as a governor wasn't up. So he stayed. He kept voting on policy. He kept speaking out. He became the most vocal advocate for Federal Reserve independence inside the building. Eccles remained a governor until 1951. 3 years of resistance. 3 years of being a thorn in Truman's side. 3 years of proving that a president could remove a chair, but couldn't silence the institution. Now, fast forward to 2026. Jerome Powell is in almost the exact same position. Trump wants him gone. The DOJ investigation provides the pretext. The Cook case establishes that for-cause removals are possible. But Powell's term as a governor runs until 2028. Even if Trump strips him of the chair title, Powell can pull an Eccles. He can stay on the board. He can keep voting. He can keep fighting. Except this time, there's a twist that Eccles never faced. Let me explain how the Federal Open Market Committee actually works, because this is where the scenario gets really interesting. The FOMC is the body that sets interest rates. It has 12 voting members. 7 are the Board of Governors, appointed by the President and confirmed by the Senate. 5 are regional Federal Reserve Bank presidents who rotate through voting seats. Now, here's the key. The FOMC has its own rules, its own procedures, its own chairman. Traditionally, the chairman of the FOMC is the same person as the chair of the Federal Reserve Board of Governors, but that's tradition. It's not law. The FOMC can elect whoever it wants as its chairman. You see where this is going? If Trump removes Powell as Fed chair and appoints someone else, the FOMC members, the governors and regional bank presidents who actually know how to run a central bank, face a choice. Do they accept Trump's appointee as their leader? Or do they elect Powell, who is still a sitting governor, as the chairman of the FOMC? Deutsche Bank's chief U.S. economist, Matthew Luzetti, laid this out explicitly. Quote, "If the administration insists on following through with a criminal prosecution of Chair Powell, and Senate Republicans stand firm in not advancing nominees to the Federal Reserve Board, it is likely the FOMC would choose Powell to remain on as chair." Read that again. The FOMC would choose Powell to remain on as chair. Not because Trump says so, because the committee says so. Now let me walk you through exactly how this plays out. Remember, this is a scenario based on analysis from major financial institutions, not a prediction. It's March 2026. Trump has fired Powell as Fed chair, citing the ongoing DOJ investigation into the headquarters renovation. He nominates his own candidate. Let's call him Chairman X, someone with no central banking experience but complete loyalty to the president. Senate Republicans, facing enormous pressure from the financial sector, refuse to advance the nomination. They remember what happened with Lisa Cook. They see the market volatility every time Trump attacks the Fed. Some of them are up for re-election, and their donors are screaming at them. The nomination stalls. Meanwhile, Powell refuses to resign from the Board of Governors. He shows up to work every day at the Eccles building. He attends FOMC meetings. He votes on policy. The next FOMC meeting arrives. The committee has to elect its leadership. Trump's acting appointee, let's say a Treasury official temporarily detailed to the Fed, shows up and claims to be in charge. The governors look at each other, and they vote. Powell is elected chairman of the FOMC by a margin of 8-4. Now you have two people claiming to be in charge of the Federal Reserve. Chairman X, recognized by the White House, claims he has the authority to set monetary policy. Chairman Powell, recognized by the FOMC, claims the committee makes monetary policy and the committee chose him. Who's right? Here's where the constitutional crisis explodes. The Federal Reserve Act gives the president the power to appoint the chair of the Board of Governors. But it also gives the FOMC independence in setting monetary policy. These two powers have never come into direct conflict because no president has ever pushed this hard. Trump's lawyers argue that the chair of the Board of Governors is automatically the leader of the entire Federal Reserve System. They cite administrative law. They cite presidential authority. Powell's lawyers argue that the FOMC's independence is constitutionally protected. They cite the Fed's unique status that the Supreme Court itself acknowledged in the earlier removal cases. They cite the Federal Reserve Act's explicit protections. Both sides file emergency motions in federal court. And suddenly, judges, political appointees themselves, are being asked to decide who controls American monetary policy. This is exactly what the Federal Reserve's founders were trying to prevent. They created an independent central bank specifically so that political disputes wouldn't infect monetary policy. They built walls between the Fed and the political system. Those walls are now rubble. Now, let me describe what happens in the markets, because this is where the scenario turns truly apocalyptic. The FOMC meeting concludes. Under Powell's leadership, the committee decides to keep interest rates unchanged. They issue a statement citing economic uncertainty and the need for stable policy during a period of institutional stress. 2 hours later, Chairman X holds his own press conference. He announces that the Federal Reserve is cutting rates by 50 basis points, effective immediately. He claims this is the binding policy decision. Wall Street has a collective heart attack. Which rate is real? Banks don't know what rate to use for interbank lending. Mortgage companies don't know what rate to quote customers. Bond traders don't know how to price Treasury securities. The financial system runs on certainty. It runs on knowing that when the Fed announces a rate, that rate is real. The moment that certainty disappears, the system starts to seize up. Trading volume on the New York Stock Exchange drops by 60% because nobody knows what anything is worth. The VIX, the so-called fear index, spikes to levels not seen since the 2008 financial crisis. Foreign central banks start making contingency plans. The European Central Bank holds emergency sessions. The Bank of Japan begins diversifying out of dollar reserves. The People's Bank of China, which holds over $1 trillion in U.S. treasuries, starts quietly selling. Because here's the thing about the global financial system. It's built on trust. Trust that American institutions work. Trust that the dollar is stable. Trust that the Federal Reserve knows what it's doing. 2 Fed chairs means no one knows who's doing what. And no one trusts a system that can't decide who's in charge. The international implications are staggering. For 80 years, the U.S. dollar has been the world's reserve currency. Countries hold dollars because they trust the United States. They trust our institutions. They trust our rule of law. The moment America has 2 competing central bank chairs, that trust evaporates. Saudi Arabia, which has priced oil in dollars since 1974, starts having conversations with China about alternative arrangements. The BRICS nations accelerate their plans for a competing currency. European companies that have always invoiced in dollars start switching to euros. This doesn't happen overnight, but it starts. And once it starts, it's very hard to reverse. One former Treasury official, speaking on background, puts it bluntly. The dollar's dominance was never guaranteed. It was earned by decades of institutional stability. You can lose in a month what took 80 years to build. And here's the darkest part of this scenario. Other countries start looking at the United States the way we used to look at countries like Argentina or Turkey. Countries where political interference in central banking destroyed economic stability. Countries where inflation spiraled because leaders couldn't resist printing money. American exceptionalism was always partly a story we told ourselves. But it was a story backed by real institutions doing real work. The Federal Reserve was the crown jewel of those institutions. In this scenario, that jewel is shattered. So how does this end? What are the possible off-ramps? Scenario A. The courts intervene quickly. A federal judge rules definitively that either Trump's appointee or the FOMC's election of Powell is the legitimate authority. The losing side accepts the ruling, order is restored. Problem: court cases take time, months at minimum. The economic damage happens in days. Scenario B. Senate Republicans break. They confirm Trump's nominee just to end the chaos. Chairman X becomes the uncontested Fed chair. Powell is marginalized. Problem: this means complete presidential control of the Fed. Every future president can do the same thing. Fed independence is permanently dead. Scenario C: Trump backs down. Facing market chaos and international pressure, he reaches a deal. Powell stays through his original term. The DOJ investigation is quietly dropped. Problem: Trump doesn't back down. That's not who he is. The more pressure he faces, the harder he pushes. Scenario D: Congress acts. They pass emergency legislation clarifying Fed independence and limiting presidential removal power. Problem: would Trump sign such a bill? And if he vetoed it, could Congress override? There is no good outcome here. Every path leads through some form of institutional damage. The only question is how much damage and how permanent. This is where we are in January 2026, a Supreme Court case that could gut Fed independence, a DOJ investigation targeting the Fed chair, a president who has made no secret of wanting to control monetary policy, and a scenario laid out by Deutsche Bank, one of the largest banks in the world, where America ends up with two competing Federal Reserve chairs. I want to be absolutely clear. This scenario has not happened. It may not happen. But for the first time in American history, it's possible. The legal pathway exists. The political will exists. The only question is whether the institutions hold. Here's what I need from you right now. First, if you've made it this far and you're not subscribed, now is the time. Hit that button and the notification bell. Because if any part of this scenario starts unfolding, you need to know in real time, not hours later when the cable news catches up. Now. Second, share this video. Send it to everyone you know who has a bank account, a mortgage, a retirement fund, any connection to the American economy. They need to understand what's at stake. Third, drop a comment below. Tell me, do you think the FOMC would actually defy a presidential appointment? Do you think Powell has the courage to pull an Eccles? I want to know what you think. The Federal Reserve was designed to be boring. It was designed to be independent. It was designed to operate in the background while Americans went about their lives. That era is over. Welcome to the new reality. 2 Fed chairs, 2 interest rates, 1 broken system. This is Red Team Politics. I'll see you in the next one.